Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Today's topic is limited liability company, and our focus is on journal entries. What are the objectives? At the end of the lesson, you should be able to demonstrate how to journalize the issue of shares, the issue of debentures, the redemption of debentures, and the payment of debenture interest. And we're going to just go through a worked example. This question is taken from May 2012, number 5B. So the question is May 2012, 5B. Now, the first thing that you're doing is to read through the question. So the question reads, Aries Limited as an authorized share capital of $200,001 ordinary shares and $101 8% preference shares. When we say authorized, remember that was looked at in our previous lesson. The link is in the description below. On April 1st, 2011, the following balances were listed in its books. 165,000 shares for ordinary were sold at $1 each out of the authorized of 200,000. 83,000 8% preference shares were sold at $1 each, and that is out of the authorized of 100,000. 10% debentures was issued, and the value there is 41,000. When we say debentures issued, it means that they have acquired that long-term loan. The 10% that you're seeing beside that represents the interest to be paid on the debenture per year. The 8% beside the preference shares indicate the rate of the dividend to be paid out to the preference shareholders. And on April 1st, 2011, Aries Limited issues the remaining ordinary and preference shares for cash. So what they're saying is that the shares that weren't sold for ordinary and preference shares, those were sold on April 1st, 2011 for cash. Buys back 21,000 in debentures with the cash received. So what they did basically with the debenture here, when it says buys back, it means that you are paying off some of that loan. Or they could use the term redemption of debentures, meaning you're paying off a part of what you're owing for the debenture. What are you required to do? Draft journal entries to record the issue of the remaining ordinary shares at $1.50 each. So you notice that it is being sold for more than its nominal value. The nominal value is $1. It is being sold for $1.50. So there and then we know that there is share premium. 2, the issue of the remaining preference shares at $1 each and the reduction in debentures. So those are what are required for the question, which was taken from May 2012, number 5B. So we're going to start with the first item there, and the date is 2011, April 1st, and the information that we got is that they issued the remaining ordinary shares. Now, the authorized share capital, meaning what they're authorized to sell, what they're allowed to sell is 200,000. They had sold 165,000 of that. In order for you to know the amount of shares that they are issuing, right here when it says they issue the remaining ordinary shares, remember the authorized is 200,000 and they have sold 165,000 of that. So you have to do your calculation to find out the number of shares that were remaining in order for you to sell them. So it's 200,000, which was authorized share capital, minus the 165,000 shares that were sold, and then you would get a value of 35,000. This 35,000 shares ordinary are what you are selling when it states the remaining. You are to issue the remaining ordinary shares at $1.50 each. So we're now going to make our recording in the general journal. Now, please note that when you issue shares, the double entry for the issue of shares is that you debit cash or bank, and you would credit the share capital, whether it is preference or it is ordinary. So remember, the double entry is to debit cash or bank and credit your share capital. Now here we go. The amount of shares, that were sold is 35,000. So we're debiting cash because it indicated that the amount was received in cash. And we're going to do our calculation right here. You can do your calculation outside of the journal. All you would need to do is to write workings. Cash, and it is 35,000 times the value at what each shares were sold for. And that is $1. That is $1.50. Now, the amount that you get, you're going to debit that to your cash account. And when you multiply 35,000 by the $1.50, you get a value of 52,500. So based on the 35,000 ordinary shares that were sold, the business generated cash of 52,500. The other thing that you're going to do now is to ensure that you make your credit entry. In making your credit entry, you're going to record what you receive for the ordinary share capital, because that's an increase in capital. Once you sell shares, that's an increase in capital. And the value that you're going to record is at the par value or the nominal value or the face value. So that would be 35,000 times the rate of $1. So in our calculation, that would be 35,000 multiplied by $1. And that gives you a value of 35,000. So what we're saying is that our ordinary share capital increased by $35,000. Now, the extra 50 cents would constitute your share premium. So therefore, we're going to credit our share premium with the extra 50 cents per share that were sold. So that would be 35,000 times 50 cents. And the value is 17,500. Now, there's another way in which you could have calculated your share premium. The fact that we received 52,500 for the ordinary shares that were sold and that was sold above par, and we have calculated our ordinary share capital at the face value, which is a nominal value, that is what you record as your share capital. The difference between the 52,500 and the 35,000 would give you 17,500. So instead of multiplying that 35,000 shares by the extra 50 cents, which would have been our share premium, you could go ahead and subtract the 35,000 that we have received in the share capital, ordinary share capital, from the total value of cash that was received from selling the shares. No, it indicated that narratives are not required. So therefore, we're not going to write our narrative. We're now going to move into the other set of information, which will be part two of the question, and that is the issue of remaining preference shares at $1 each. The nominal value for the preference is $1, so therefore there is no share premium. The same double entry rule applies for the issue of preference shares, so therefore we're going to debit cash or bank with what we have received and credit the share capital, but in this case, you're going to indicate that it is preference shares. The question indicated that cash was received, so therefore it will be debit cash and credit the preference share capital. We notice that it is $1 that is the face value. There is no share premium. So therefore, we're just going to go ahead and do our calculation for that. So we're going to go ahead and make that entry. So our cash is debited. And in order to know the amount of shares that were sold for the preference, remember the authorized is 100,000. So they were allowed to sell 100,000, but based on information, 83,000 was already sold. So it therefore means that our preference shares that were sold is 83, and we're going to subtract that from the 100,000. So it's 100,000 minus 83,000, and that gives us a value of 17,000. Now this 17,000 is what we're going to sell. The 17,000 is what we're going to sell now, because it said issue the remaining preference shares at $1 each. So we're going to make a record of that in our general journal. The value of cash received is the number of shares that were sold, which is 17,000 times the rate of $1 each. And that gives us a value of 17,000. So we're seeing where the business generated $17,000 from the issue of preference shares. Now that we have that, let us do our calculation to determine the amount of preference shares, share capital that we have generated from that sale. And it is 8% preference share capital. And because it is sold at the nominal value, which is $1, all of that will go to the preference shares. If it is that it was sold for more than the $1, the extra would go to share premium. But in this case, there wasn't any share premium that was generated from the issue of the preference shares. So we're recording the 17,000 to our preference share capital. We're now looking at part 3, which is the reduction in debentures. The information provided is that 41,000 was generated from the issue of debentures, meaning the business acquired a loan of 41,000. However, out of the sale of the shares, the business paid back $21,000 on the loan. So there's a reduction in the loan. The first thing that we're going to look at so that you can understand the concept is to look at the double entry for the issue of debentures. Now, when you issue the debenture, remember you are acquiring a loan, and that is an increase in the liability. So therefore, you're going to debit your cash or bank, depending on what you receive, or you received the loan, and you would credit that debenture. Remember, that is an increase in the liability. Okay, now we're going to look at when there is a reduction, meaning that you are repaying the liability. So we're looking at the repayment of debentures, meaning the repayment of the loan. Or the question can state the redemption of debentures. Redemption of debentures is basically the reduction in the debenture. What are you doing? Debenture is a liability. So when the liability is decreased, you are to debit. So what we're going to debit is the debentures. Reduction in the loan, and we're going to credit what we use to make that payment, whether it is cash or bank. Okay, so remember, once you issue the debenture, it means that you have acquired a loan, which is a debenture is a long-term liability. So therefore, you would debit your cash or bank and credit your debentures. Repayment of debentures, meaning there's a reduction in the debenture, or you could safely say a redemption of debentures, the very same thing. You debit your debentures because that is a loan, that's a reduction in the liability, and you credit your cash or bank. No, based on that, we're now going to use that information to do part 3 of the question. So we're looking at part 3 of the question. So here we go. The reduction in debentures. $41,000 cash was generated from the issue of debentures, and they have paid back 21,000. So it simply means that the business paid 21,000, and based on that, we're now going to make the entry. And remember, once you pay back a part of the debenture or clear off the debenture, that there's a reduction, so therefore the item to be debited is debentures, and the actual value that was paid is 21,000. And we're going to credit cash because the question did indicated that they have used cash to make that payment. So our item to be credited is cash, and the value is 21,000. Okay, now what we're going to look at next is an addition to the question, and that is the payment of interest due on the remaining debentures. Payment of interest due on the remaining debentures. How do we know what is the interest, right? If you look at the question, you would notice that they indicated that 10% debentures. This 10% indicates the rate to be charged for interest on the debenture per year. They indicated that we are to show the journal entry to record the interest due on the remaining debentures. If it is that 41,000 was issued, we received $41,000 in debenture, and they have paid back 21,000, it means that what we're going to pay the interest on is 20,000, right? So 41,000 minus 21,000 give us 20,000. 10% of 20,000 give us $2,000. That is the interest to be paid on debenture. So we're going to make the entries now in the general journal to record the payment of interest due on the remaining debentures. Remember, we have calculated, and based on that, the interest on debentures is 2,000. Now, debenture interest is an expense. So therefore, we're going to debit debenture interest. So debenture interest is the item to be debited, and the value is $2,000, and the item to be credited would be cash, because that is what we have used to pay the interest, and that is $2,000. $3,000. Just to recap what we have done for this session, we have looked at the issue of shares. Once you issue shares, the cash or bank is debited and the share capital is credited. If it is that you have issued above the par value or the nominal value, also called the face value, that extra that is generated from issuing the shares will go to share premium. We have also looked at the issue of debenture. Remember, issuing debenture is where you have acquired that loan. So there's an increase in the liability. So your cash or bank is debited and the debentures is credited. We have also looked at the redemption of debentures, which is the reduction in debentures, meaning you're paying back what was borrowed. You're reducing the loan. There's a reduction in liability in that case. So therefore, you debit your debentures and credit your cash or bank, whatever method is used to make the payment. The next thing that we looked at was the payment of debenture interest. And remember, once you're given the rate beside debenture, as you're seeing right here in the question, 10%, this 10% represents the rate to be charged on the interest per year, the rate to be charged on the debentures per year. This 10% represents the rate to be charged on debentures for interest per year, right? Now, the other thing that we have looked at is how to meet the journal entries for that. And the journal entry is the debitor debenture interest, because remember, debenture interest is an expense to the business. It's an expense that the business has incurred as a result of borrowing that loan. And once you're paying that expense, the whatever you use to make that payment, whether it is cash or by check, which would have been bank, that is credited. And because there's an increase in the expense, you debit. So those are the areas that we have covered for this lesson. In our next lesson, we're going to look at a worked example in preparing financial statements for a limited liability company.
Like, share, and don't forget to subscribe.